Right. I also asked you to take a look at the website, and I'm afraid to say I can't show you now, so I'm going to spell it out for you: www.tax hyphen is the little dash radar radar.com. And excuse me using different terminologies here. I often get told off by my American friends that a dummy is not a binky or a soothie in America. A dummy is a large item that people dress up with clothes. Where I come from, a dummy is a binky or a soothie. So I'm very careful about my choice of terminology sometimes. So it's www.taxradar, tax then hyphen radar.com. I asked you please to get hold of my Chief Operating Officer, Gilfer, Gilfer. In fact, what I can do is just his email address. I did send this to you, is gilfer@me.com. So what I'd like you to do, if you don't have a username and a password to get into www.taxradar.com, you need a password and a username. And what I want you to do over the next month and a half is to go in there, take a look at that site. The site really is a practical manifestation of the materials that we will deal with towards the end of this course, dealing with tax risk management. As I said to you before, part of my duty is to share with you the large topic of international tax planning and to take you through the terminology. Professor Burns has been helping you and explaining to you how to access some of the broad research, and really just so that you are equipped with various tools to help you ultimately establish yourselves in international tax practice in one form or another. The Tax Radar site is a manifestation of the tax risk management principles that I have applied over many, many years in various countries. So as I've said to you before, it's not just international tax planning doesn't just involve the cross-border aspects. You are going to have to come to terms with some of the domestic tax legislation in the transactions that you get involved in. And one of the best entry points, and I'm thinking of some of you who currently run practices in some of the tax haven countries, no doubt already have a number of clients who are making and taking advantage of existing structures, setting up an offshore trust and having an offshore bank account and all the basic stuff. There's a golden opportunity for you to visit the wealthier of those clients, and most of them should be in a bracket where they can afford to spend this extra money, and to suggest to them that you take a look at what their current structure is to determine to what extent they may fall foul or short of some of the legal provisions, not necessarily in the tax haven jurisdiction where you're practicing from, but ultimately if they're American citizens, if they're falling foul of any of the American tax laws insofar as the way that they've structured their affairs, or the European tax laws, or whatever the case may be. And it becomes a great opportunity for you to start loading information about these clients. And what the Tax Radar site does is, if you go into the site, it is divided up into 4 modules. And what it will do, it helps you divide up into modules the different steps that you need to take in order to take these clients through a tax risk management process, which first and foremost is to document what their current status is, and then to double check that what they are currently doing in fact is correct and in line with the various requirements that exist in the different jurisdictions where they may in fact be situated. Now once you have a game plan of where they are currently at, of course that places you in a very powerful position to be able to now suggest additional refinements to their existing structure. And just to give you, I will cite these statistics again. in my experience, and also just having read a lot of literature on this, in my experience, you'll find, and I'm talking about companies that are not public companies, because public companies, and particularly American public companies, have come under close scrutiny, and there's a tremendous amount of transparency which now exists. And public companies tend not to be in this position, but non-public companies, companies who don't have to publish their results, this can include family companies, family-held companies, family trusts, various joint venture type structures which do not have to subscribe to any regulations such as what the SEC requires, or that are not listed on a particular stock exchange around the world. You'll find that a lot of these entities, if you had to do a proper analysis, anything between 40 and 70% of their potential tax exposure remains uncovered. Now that is quite a remarkable figure if you consider what their current tax bill might be, and if they were to be caught out by the tax authorities, they may face tax bills of anything between an additional 40 to 70% of what their current tax bill is in a current year of assessment. And of course you would multiply that by the number of years that the tax authority could go back. If fraud has inadvertently been committed, then of course in most jurisdictions the tax authorities can go back to the year dot. One doesn't want to think that any particular client has gone and conducted their affairs in a fraudulent manner, but unfortunately a lot of the legislation that you'll come across around the world sets out a presumptive, the law is presumptive in this regard. In other words, it's a rebuttable presumption that you are deemed to have committed an offense which is tantamount to fraud unless you can prove the contrary. And many tax jurisdictions simply apply their penalty provisions on that basis. Now, if you're dealing with the United States of America, correct me if I'm wrong, but I think the maximum penalty that you are exposed to in the case of a fraud is 75%. Go to the other extreme in the Republic of South Africa, for instance. Forget about having even conducted a fraud. Your penalty exposure opening gambit is 200%. So think about that. If you owe $10,000 tax, arrear tax, because you've made a mistake, we'll add 200% penalties to that. That takes it to $30,000, and then still add another 100% interest to that, to the original 10,000. So you're looking at so on an original 10,000 exposure, you're looking at a $40,000 exposure. Well, if we take that number to $100,000, that's a $400,000 exposure. And South Africa, coming out of the Commonwealth group of countries or family of countries, you'll see when you go and look at this, the Commonwealth family of companies all originate obviously from the United Kingdom. They make up one of the biggest blocks or family blocks of countries in the world, and you'll find that the penalty provisions are quite similar between those, anything between 100 and 200%. So it's a huge deterrent, and with the free flow of information that's taking place internationally, there's a lot of motivation to get existing clients who are in existing structures to have you confidentially re-look at those structures and come up with refinement suggestions. And that becomes a great source of work where you are going to be seriously helping those clients in a very positive way. And again, Tax Radar is something that will help you do that. And I wanted you to take a look at that as a practical exercise in preparing for the lectures that are going to come up towards the end of this particular session.